Hi, I'm Joshua Dudgeon with realestateinvestmentresults.com. I want to discuss defining comps. This is also known as a comparable or a comparable market analysis. The definition of a comp is basically to show what the finished value of the property will be based on current sales. When you talk about an appraisal, a true appraisal starts with how long ago the comparables sold. So generally they're supposed to be within 6 months, and then they should be a similar location as far as how close to the property it exists, and then it should be similar bedrooms and bathrooms, and vintage of property, meaning it should be something that's built in the same decade or few decades. Style has a lot to do with vintage. Changes in style happened with changes in decades, specifically after the Great Depression, and then post-World War II, housing changed quite a bit. Ranches really came into vogue after the World War II era because they were easier to build and they were very popular by the buyers. But these are the things that come together to create an appraisal and really a comparable market analysis as well. The main difference between an appraisal and a comparable market analysis is an appraisal is an official document done by an appraiser. A comparable market analysis is done by generally a realtor or an investor like myself. I personally trust a comparative market analysis more than an appraisal because a comparative market analysis is generally done by people that have a vested interest in the property, whereas an appraisal is done by a trained person. Generally speaking, if you were to say, would you rather have somebody who does surgery every day do your surgery, or would you rather have someone who teaches surgery every day do your surgery? You're going to probably lean towards the guy that does it every day. And that's really the difference between a comparable market analysis and a appraisal. That doesn't mean that all appraisals are bad. They're not, and it doesn't mean that all comparable market analysis are good. They're not, but they give you a general feel of what the value is. You can kind of do your own comparative market analysis by even going on like a website like Zillow or Trulia, which I think they're all the same site now. Redfin's another one. ABC Real Estate is another one where you can pick your address and then get a feel for all the houses in the area that what they've sold for. The danger of doing it on your own is there are stark divisions and value change on streets, waterways, train tracks, or even parts of town. So for instance, in our market, there is a street called West Avenue. West Avenue is really the 1200 block, so it would really be 12th Street if it didn't have that name. And then there's another street called Losey Boulevard, which would be 2400. It would be the 2400 block. Everything to the west or close to the river of West Avenue has a lower value than everything that is to the east of it. And then when you get north and south as well, value changes occur. And so you've heard the old adage, location, location, location when it comes to real estate, and having the proper appraisal or comparative market analysis makes a difference based on those locations. When you're looking at a investment portfolio or buying a product, it's very nice or very important to have a comparative market analysis or comparables done, or even an appraisal done, because the finished value of the house is crucial in determining the loan to value, which you can check out another video of ours talking about loan to value. And it also is crucial to find out what you can actually make on the project. So if you have poor comparative market analysis or poor idea of the finished value, especially if you have overvalued the finished value, it's really where the difficulty comes. So let's say, just to put some numbers to it, let's say you had a comparative market analysis done and it was 200,000. So you base your loan to value on that, and let's say you're only in at 75% loan to value. So you would be at 150 would be your finished, your maximum allowable offer, your top number as far as what you're going to have for a spread. But then your comparables, when you get the project done, actually only bring it to like 180. That when you actually sell it, it only sells for 180. now your loan to value ratio was way over 75% because your comparable market analysis was off at the beginning. We tend to try to be very conservative on the comparative market analysis, meaning if we think that we're going to sell for 200, we'll actually factor it in at like 179.9 or 189.9, which is where we'd probably list the property, or we would expect to list the property. And then when we get the project done, especially in an up market, many times the $200,000 number actually works. And so now you have a bonus $10,000 to $20,000 in your spread because you were careful on your comparative market analysis at the beginning of the project. Again, a comparative market analysis is otherwise known as comps or comparables, is done by a realtor. It's done with the same idea in mind as an appraisal. It's just not done officially by an appraiser. Like I said, I would rather have a comparative market analysis in most cases because it's done by people who have a vested interest in the projects and really are selling many of the projects that the comparables are based on. With that, if you have any questions and would love a chat about how you can make great money with us on an investment project, you can reach out to me on my cell phone at 608-306-1199, or you can check us out on my website at realestateinvestmentresults.com. A shortened URL for that is reir.co, reir.co. With that, have a great day.